Lee, welcome. Nice to have you on our sofa here at SuperReturn International.
Good to be back.
Again. Now, last year when I saw you here, I described you as a well-informed optimist, I think. So would you still characterise yourself as that? And if so, why, and what challenges are you seeing in the landscape at the moment?
Yeah, this year it's actually a little bit more even, I would say. Obviously, there's a lot of macro volatility. We have issues in the Middle East with the war, how that leads into inflation, particularly in the US as well as in Europe. And I'd say for the first time in the last 4 years, we're starting to see more opportunities on the distress side. And that's something in a world where US nominal GDP growth is going to be 5+% is not something I would normally say in that sense. So we're starting to see things pick up in a couple of areas that will lead to more distressed opportunities. So in the very short term, I'd agree with you. I'm somewhat of an optimist. Coming into the year, we actually thought with continued growth, it actually wouldn't be the best year for credit markets specifically. And then ultimately that could lead to some more distressed opportunities, which I guess I was thinking about it, the last couple of days. It's a bit perverse to be optimistic about distressed opportunities, but that's an area that is something we've not seen for many years that we're potentially looking forward to in the next, call it 12 to 24 months.
And there's been a lot of discussion already this week around defaults, particularly in the software
Yes.
sector. What are you seeing there, and how are you approaching that market? And is there going to be, as you described there, a sort of extended distress cycle, do you think?
Of course. So taking a step back in private credit as a whole, ultimately we don't view these as systemic risks. We think the lending that banks have done has actually been relatively benign, and it would take a lot. It would take 30, 40% type defaults in order to have any sort of issues with the banks specifically. The weird thing that's happened in private credit the last decade is that there's been no dispersion. So there's been no difference in manager performance. So the difference between the best managers in private credit and the worst managers in private credit has only been 2 to 250 basis points. And in every other credit asset class, what you typically see is between the best performing and the worst performing, it's 500 plus basis points. So there's just been relatively similar performance everywhere, which is not normal. To your direct question, a lot of what's happening in private credit today reminds me of what happened in real estate back in post-COVID, where there was a lot of worries that nobody was ever going to go to the office again, nobody was ever going to go to the mall. At that time in the commercial mortgage-backed market, you saw 11% of issuers were in special servicing, which is sort of like a pre-default, which is very similar in private credit today, where you have 11% of issuers that are PIKing, so they're paying in cash or paying in kind instead of in cash. Ultimately, what happened in the last 7 years in real estate is the annualized default rate's only been about 1.5%. So when we think about private credit, and I think I read an article a couple months ago, it was described as defaults in private credit is going to be like watching paint dry on the wall. So we do think it'll happen. We think it's going to take an extended period of time. And specifically with the software, it's like no other, or it's like every other industry you look at. Every company is extremely bespoke in nature. So some will do really well, some will do poorly. And take it back to my original point, that's why you're going to see a lot of manager dispersion at this point in time. But we've not seen any forced sellers. But ultimately, you will start to see defaults come up, but probably not at the pace that I think most people are worried about.
With all of that in mind, earlier you said it's slightly perverse to kind of be
Exactly.
optimistic about.
Yes.
Where do you see the opportunities in that environment?
Yeah, so I'd say generally on the distress side specifically, when you look back, and I've been doing this almost 30 years now, in every cycle, typically where you have the most issuance the last decade is where you tend to have the most level of defaults. So the sectors where you have that issuance in this last decade, one in software, as you mentioned, not surprisingly, and that's about 15% of the broadly syndicated market, 25% of the private credit market. Healthcare, particularly in the US, healthcare is interesting. I've covered healthcare for a long time, where it used to be a darling sector where nobody would worry about it and you put a lot of leverage on it. Now, as you're having budgetary constraints in the US, you have highly levered companies as well as potentially pull back on reimbursement from states and the federal government. And then the other area is media telecom, similarly going through massive transition. And honestly, when we look at software, we think a lot about it like what happened in media telecom post the internet's arrival in the early 2000s, where some of these will be like radio, some of them will be like TV, some of them will be like newspapers. And that's how we kind of think about the go-forward opportunity, particularly on the distress side.
So how will you be positioning yourselves as a firm in that environment when potentially the band-aids are coming off in terms of those kind of liability management exercises that have been deployed?
Yeah. So generally, I'd say, as I mentioned, coming to the year, we thought even though growth was going to be relatively strong in the US, probably not as strong in Europe, but not bad. Spreads were tight. I think that's been a consistent theme that we've probably had for the last 4+ years as I've been here post-COVID. So we came into the year with relatively high cash again, with the assumption that we didn't know what was going to be the trigger for things to pull back. Ultimately, though, on a year-to-date basis, we've seen very small pullbacks. But really, the times like this is you want to keep your dry powder available. As you mentioned, there's been a lot of things to do in that liability management space. We're doing a lot of things in the structured products market as well. So too, I think that's been a consistent theme. If anything, our ability to provide capital relief to banks in both Europe or here in Europe as well as in the US, that's actually accelerated in the last few years. And banks like having sort of partners they can trust and count on. So we've seen a lot of repeat business on that side. And then the other thing we talked about a little bit last year that continues to accelerate is in the real estate space. Not in data centers. I think data centers, we feel like other people have sort of that market a bit covered. So we continue to see either on the housing side, the condo new construction side. We've done a lot in the leisure space as well, so too, in Europe as well as the US. So real estate's another area where banks are pulling back from that. That's an area where we can step in. So there's good, I'd say, lending we could do today, but liquid markets are just not providing that opportunity right now.
Is it quite an exciting time for you to be doing what you're doing when you are having to think differently? You are having to look at an ever-evolving picture. It's very different to the sort of previous decade, isn't it?
Yeah, so things are, even in, obviously with the AI world, things are changing very quickly. Typically, when we would have pullbacks historically, they would last a little bit longer. I mean, now you get pullbacks and they might last 24 hours in some circumstances or 5 or 6 days. And obviously even one tweet, can change things pretty dramatically. So it makes our job actually a little bit tougher. So that's why when we think about it, really locking up capital has been very important because you never want to be a forced seller. And I think that's some of the issues you're seeing in the private credit market today is there are forced sellers of things. So it's an exciting environment. It's more challenging, it's different, and we've had to change our sort of process a bit over the course of the last 20 years in that sense. But ultimately, and a lot of our clients say, there's so many things must be going on. There's a lot of macro volatility, but underlying, when you look at like high yield spreads in the US, during the peak of the Middle East conflict this year, spreads only widened out 25 basis points. So we've not seen the individual name volatility as much as we've seen the top-down macro volatility. So for us, as being a deep fundamental investor, it's probably not as exciting as just watching the screens have been. So but it's good. It keeps us interested on a day-to-day basis.
And being here at SuperReturn International with 6,000 of your industry colleagues, presumably you take away a few ideas for the next 12 months too.
Yeah, I mean, honestly, it's interesting to hear how different people are having different views on the world. Even when we talk to our clients, you could talk to 5 people and get 10 different views as well. So it's always interesting, particularly coming from the States, to get the Middle East view, the European view. Obviously, every country has a unique view as well also. So it's really interesting to meet people in person and get those sort of out-of-the-box views relative to what we see, being in the U.S. specifically.
Well, Lee, we always appreciate you giving us your views in the studio. Thank you so much for joining me.
Thank you so much.
Great to see you.
Thank you.